It's over 2 years since inflation broke above the Fed's 2% target. It took the Fed another year before they stopped describing it as transitory. Inflation has been above 3% since April 2021, and that's using the Fed's preferred measure, which is the Personal Consumption Expenditures Deflator, or PCE. They prefer PCE because the weights in it shift dynamically. The Consumer Price Index, or CPI, gets more attention. It's used, for example, to make the annual cost of living adjustment to Social Security, which, by the way, was 8.7% last summer when they set their figure for 2023. The weights in the CPI are fixed, so if apples go up in price compared with oranges, CPI assumes people still buy the same amount of apples. PCE uses what actually happens, which is a shift towards oranges. So PCE is more accurate. Although inflation is down from its worst levels, it's showing signs of becoming entrenched above 4%. The annual change in the PCE has been above 4% for nearly 18 months. Pay raises are starting to reflect the reality of inflation well above the Fed's target. The Employment Cost Index rose at 1.2% last quarter compared with the prior one. Wages are rising at 5%. And why not? Why should workers accept a drop in real living standards by receiving an annual pay raise below inflation? The government is responsible for rising prices through excessive spending that was boosted when Joe Biden became president. The Fed poured fuel on the fire by keeping rates low for too long and partly monetizing the federal debt with quantitative easing. Expectations of future inflation have also been rising. For a while, consumers had faith that inflation would quickly return to 2%, but they're adjusting to the new reality. The inflation rate people expect has been rising all year. As an investor, you need to consider whether 4% inflation is more likely than a return to 2%. Ask yourself if your portfolio offers protection against steadily rising prices, because that's starting to look like the new normal. We think energy infrastructure, with its visible cash flows, growing dividends, falling leverage, and critical role in the energy transition, offers good long-term protection. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.